Good afternoon, everybody, and welcome to the latest Professional Advisor Working Lunch event. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for this first virtual session for the next hour. Before we get going, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off and would be most grateful if you could keep them that way. It will ensure there's no background noise, so myself and my guest Ross from Baillie Gifford can be heard clearly throughout this event. I should also inform you this session is being recorded and we will send you a link of the recording by tomorrow. Do, of course, feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. That reminds me, if you haven't got your full name displayed on this Zoom call, it's difficult for us at Professional Advisor to see if you've attended this event or not. So please make sure you're displaying your full name so we can get you your CPD. We don't want you missing out on receiving that. Now, with growing concern about inflation, market volatility, and base rate rises, not to mention the recent invasion of Ukraine, investing for growth is more challenging today than it has been for a generation. So with that backdrop in mind, I'm delighted to be joined today by Baillie Gifford's Ross Mathison, who is an investment manager on their global income growth team. Ross will discuss how a focus on long-term income and growth best positions the fund to face these challenges I just mentioned. Once I'm done with my introduction, Ross will present for 5 minutes or so before I throw some questions at him. Then I'll put all your questions from the audience to him in the last 15 minutes or so. So do feel free to put any and all of your questions to Ross using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message. That way, only I can see it. Now, just before I hand over to Ross, let me quickly run you through our learning objectives for today's session. They are to develop an understanding of the importance of a growth mindset when building portfolios for a client's long-term income needs, understand the building blocks of resilience in an equity income portfolio, review where some of the most interesting income investment opportunities over the next decade are likely to be, and finally, understand how a long-term investment horizon affects the approach to sustainability and engagement. So that's the objectives and CPD covered. I'll now hand over to Ross Mathison from Baillie Gifford. Good afternoon, Ross.
Hi, Tom. Thank you very much. And thank you, everyone, for taking the time today to join me for this working lunch as I hopefully bring to life what the global income growth strategy is at Baillie Gifford. So as Tom said, my name is Ross Mathison. I am one of the co-managers on our global income growth strategies at Baillie Gifford. I started my career at Standard Life Investments and I was there for the best part of a decade before joining Aviva Investors and then eventually landed at Baillie Gifford in October 2019. So as Tom mentioned, I will have a very brief presentation. It's only three slides long and will take only about 5 or 6 minutes, trying to bring to life how we do income investing and what we're looking to achieve for your clients. And a couple of stock examples. So within our team, we believe the best way to provide a long-term income for your clients is by focusing on long-term growth equities. And we as a team always talk about long-term income, not short-term yield. That is what we are looking to achieve. And we think we are set up with 3 main advantages that allow us to deliver that outcome for your clients. The first is we truly have a growth mindset. Everyone knows Baillie Gifford as a growth equity investment house. We are no different. And as you can see, over half of the names that we own in the portfolio are also held in other Baillie Gifford strategies. So we have the ability to tap into that full Baillie Gifford growth research capability. The second advantage we have is we are truly long-term. We walk the talk. And when we say we're long-term, you can see there the average turnover of 13%. That equates to holding companies for close to 8 years. So as a time when the market continues to shorten and shorten its time horizon, we will continue to own companies for close to a decade. And then the last advantage to highlight is that we are genuinely global. What we are looking for in our companies is quite specific, and so having the widest opportunity set is really important. And there are over 5,000 companies globally paying a dividend that are of size that we could invest in, and having access to that full market we think is really important. And with these competitive advantages, what we're looking to deliver for your clients is two objectives. The first one being a sustainable income. And what we mean by sustainable income is income that your clients should be able to rely on through thick and thin. In tougher economic times, we think our income will remain resilient. And then secondly, we want to provide them real growth in that income and the capital. So the growth ahead of inflation. So the clients with long-term horizons are able to maintain purchasing power and grow purchasing power through the period in which they own our fund. So the best way to try and illustrate what we mean when we say long-term income, not short-term yield, is with an example. And here we have in front of you an example of a decision that was made in the strategy nearly a decade ago, and which I think shows how our mind works relative to the traditional approach to income investing. So the light blue bar you see is the income received from Microsoft, and then the grey bar is income received from RWE. So we think there's a problem with traditional income funds where you can be seduced by a high starting yield, and actually what happens is you're invested in a very capital intensive business, which in the case of RWE was our judgment. You then need to see the business pivot, and a pivot in a kind of capital intense manner, in this case from coal to renewables. And what you can see has happened is they've had to cut the dividend, then eventually cancel the dividend. Whereas Microsoft is far more like the type of companies that we want to find, where maybe traditionally doesn't look like an income stock at a 2.3% starting yield, but we see it as very capital light, great growth opportunities, and take the long-term view of what the income contribution will be. And you can see at the table at the bottom, the capital return for Microsoft far in advance of RWE. That's less surprising. It's a growth company, it's done very, very well. But what I think is really interesting is the income return nearly double from Microsoft, despite that starting yield, than what you get for RWE. So what we're doing in our team is trying to find the Microsofts and making sure we don't fall in the trap of the RWEs. And at the end of every stock discussion, before we decide whether or not we're taking a position in a company, we grade the investment case across a number of areas. And one of those is the income contribution this stock will make to clients. And in this point, we're taking a judgment on what is a 10-year income contribution, not thinking about just what the starting yield is just now. What is a 10-year contribution this will bring? And then finally, just to bring it to life at a stock level, Novo Nordisk is one of the largest positions we have in the fund, and it is a Danish listed market leader in the treatment of diabetes. For every company that we own, we fill out what we call our 9-question research template. This is answering the 9 questions that we have found over time are the best questions to answer to make sure that the potential idea is a good fit for our strategy. And Novo Nordisk, our investment case, is very much built around, this is one of the world's leading compounding machines as they continue to innovate in diabetes therapies and take more market share. But our investment case is also aided by our belief that they are going to, with their innovation, develop a real obesity market, a market that doesn't exist today, but treating obesity as a chronic condition to be medicated rather than a lifestyle disease. And you can see on the boxes on the outside a number of inputs, a variety of different sources that we go to generate these insights. At the top left, you can see investigative researcher. So we have a lady on our team who's a former journalist who uses an alternative network to really get to understand what these companies are like on the inside. So for Novo Nordisk, she did a project around the R&D culture to try and understand, is this a mission-driven company really fascinated by developing new innovative medicines? We spend a lot of time speaking to industry and academics. For Novo Nordisk, for example, we had a great conversation with one of the lead investigators on their obesity trial, and that was what triggered us to go and do more work on the obesity opportunity. We leveraged the Baillie Gifford network, have had many conversations with colleagues on different strategies about either Novo Nordisk or competitors or suppliers. The dependability checklist is what we do for every name to try and determine whether this dividend that comes out of the company will be sustainable for the long term. And it's 12 questions that we answer. And it's a checklist that's been developed over time as we've seen what has been leading to cuts, what's been leading to more resilient dividends. And then finally, you can see the sustainability research. And the sustainability research should almost be thought of as a multi-stage research. So there's a bit upfront work where we have to try and identify what are the main sustainability challenges or opportunities for the business, and we'll do that before we invest. But then ongoing, a big part of our investment when you're owning something for 10 years is about engaging with the company and looking to make a difference. So we're doing ongoing sustainability research to make sure that when we're engaging with companies, we're making an impact. So those were the 3 slides that I wanted to share to introduce the strategy, why we think it's best to be focused on long-term income, not short-term yield. And I'll hand back to Tom to kick off the Q&A session.
Thanks, Ross. So I think you're something of a rare breed at Baillie Gifford, having had a long stint outside the business at Standard Life Aberdeen and Aviva, I think you said. Why did you join Baillie Gifford, and kind of what looks different within Baillie Gifford than from the outside?
Yeah, so it is quite unusual. When I look around the investment floor, my guess would be 90% plus of the investment managers are from our graduate scheme. And I think it's quite interesting to be able to look and compare outside with inside. Why did I join? There was a number of reasons relating to how I wanted to invest. I kind of learned a lot about where I thought I could add value over time. The main driver for how I wanted to change my investment style was to get more long-term. I see so many advantages of being a long-term investor. I grew frustrated with when you're investing for a year or 2 years, the balance you have between focusing on spot valuation versus the future direction of this business fell out of kilter to me. When you're investing for 10 years, if you get the fundamentals of where the industry, where that company is going right, whether the spot valuation goes back to the mean or goes up a bit, goes down a bit, that's not going to be the main determinant of your returns. So focusing on that fundamentals, I thought was a much more satisfying way to work, and where I think I can add value. In terms of the firm, the partnership structure was really important to me. I had experienced elsewhere with MiFID II and pricing pressures, research budgets continuing to be constrained, and what you could have access to do your job was kind of slowly getting pulled away from you. The partnership structure here realizes that the investment platform is absolutely critical, and so the resources that you have available to you are incredible, from whether it's access to industry experts, to academics, whether tomorrow I leave for the US for a two-week research trip to meet companies, try and find new ideas. All of these long-term projects are supported by the business. And another thing that I think is really impressive, or really I value highly about the partnership, is at times like we've seen just now, or like we've seen COVID, when there's a bit of market turmoil, elsewhere where I've been before, there's a lot of looking over your shoulder or nervousness as companies have got to present EBIT margins. Here, it's a case of you're not fixated on Bloomberg adding zero value day in, day out as the markets move up and move down. What you're doing is you're just getting on with your day job, because you know that the security is there, that you can just find that next great idea. So really, really value the partnership. And perhaps one last point is just the team structure. So we are set up as a team that only looks for income growth ideas. That's all we do, the 6 of us, day in, day out. Everywhere else I'd been previous, the income was part of a larger team, and at the end of a process, you're doing a little bit of income analysis. So I think we're set up well to succeed as a team.
You've just emphasised income and growth there. How do you balance the two, and what sacrifices do you make? Because I'm sure you have to make some compromises at some point.
Yeah, so I guess the biggest difference with a traditional income fund is our starting yield will not be multiples of the market. We're normally starting with a yield that's 20 to 40% above the market. So the typical trade-off we're making is we're not getting those high initial starting yields, but with the growth, we think we're getting the greater growth for the clients over the long term. And what that does is that opens up us to invest in some businesses which we've got room in the portfolio for a really, I guess, low yielding companies can find their way in. So we've got stocks like Fever Tree or NetEase, the gaming company in China, where it can look like it's a less obvious income idea, but because we're thinking about 10-year income and what these business models may throw off in cash in years 6, 7, 8, 9, 10, we can get access to that. So I think it's a trade-off, but it's a really rewarding trade-off when you get it right.
And then kind of looking at companies that you just mentioned where perhaps income stream isn't the first foremost priority, how do you kind of balance that when you're focusing on growth and the dividend isn't a central part of their kind of shareholder engagement and culture?
Yeah, so obviously we have the dependability checklist. So we have a way of making sure or understanding where the dividend lies within the company's priorities. So we'll spend a bit of time trying to understand. And if we think perhaps this isn't the most dependable dividend because the company have got great growth opportunities, well, then we'll try and work out, is that dividend likely to be correlated with other things in the portfolio? One thing that's interesting here is when we were in the toughest times of COVID and we were engaging with companies, we were not saying, keep your dividend, preserve your dividend. We were saying, look for opportunities to invest that cash if there's better resources and you can see the chance to take great market share or come out of this far stronger. So a conversation with Admiral, encouraging them to invest in their clients with the rebate, because what we want you to do is come out of this with customers thinking you're on their side, you're more likely to take market share. So that is very different from having to try and make sure the company keeps paying the dividend. We've got that luxury of, because we're not starting on a 4 or 5% yield that we're struggling to grow it from, we can encourage our companies to make the right long-term decisions. And there are plenty of actions where we've actually done that rather than just talking about doing that.
But before I ask my last question on this kind of income yield theme, we've got a poll to ask everyone in the audience. So hopefully, if we can get that poll up on screen right now, I think there we go. So if everyone watching can just answer the quick poll, what matters most to you when investing in an income fund? Is it starting yield, income distributions not falling, total return performance, or other? So if you just answer that poll quickly, I'll give you 5 more seconds to do so. I'll answer it myself. Lovely. And if we can get the results of that poll, hopefully a fair chunk of people have answered. Cool. So, well, what do you think about that, Ross? What were they kind of the results you were expecting?
So I have no idea what I was expecting. It's somewhat what I was hoping. So the starting yield, so 3%, that suggests I've got one person left to try and convince, but it's nice to see that people are focused on that. The fact that income distributions not falling matters most to a third doesn't surprise me. When I think about how I would use this product to fund my retirement, or if I was running a charity portfolio looking to do payouts, that is really, really important to me, and that's really, really important to us. So yeah, I think it's great for us to see the split between those two, and intrigued to see what the answer to the other is, as to what matters to that other individual.
And you in your quick presentation at the beginning, you showed the graph of Microsoft and RWE and how they're kind of, they were kind of polarized stocks in that sense in terms of their income over time and their general performance. But stocks aren't always that black and white. Do you have a lot that sits in the middle, and how do you kind of identify those ahead of time? I know you mentioned your checklist, but whatever other factors are there?
In terms of identifying the dividend cuts ahead of time?
Yeah. How do you, because you're a long-term investor, how do you spot those coming?
So I think so on the way in, we have the dividend checklist. So we have a view of what the dividend volatility may be like. And if we've scored its dependability on dividend as one of our kind of lowest 2 categories of score, it's not that we then go and try and predict when the dividends will be cut. We just try and make sure the balance of the portfolio is such that all of our portfolio or a large portion of portfolio isn't in that lowest category. What we have found, and what I think is a true experience over time, is predicting short-term dividends is a very, very tough endeavor. And you could see that through COVID, when we saw cuts of dividends for all sorts of different reasons. Like, some of the ones are more obvious, like a regulator getting involved, but you've no idea which geography the regulator is going to take that view in. There was cuts in France because seemed to be doing the right thing in France and supporting of the French economy. So I don't think we'll add value if we go through and try and work out where the cuts are. I think if we were to see over time a company's payout ratio get up really high and it looks unsustainable, or there are times where we do have companies in the portfolio who are payout ratio based, and we know if they're having an incredible time and making some supernormal profits, we'll have that in our mind that we shouldn't be banking on that growing year after year. But we have inbuilt parameters of proportion of income, no more than 5% of income can come up from any one name. So those kind of risk parameters built in there. And we really don't spend much time trying to guess where the short-term cuts will be. If there's a cut within appraise, is that for a good reason? Sometimes it can be a really impressive bit of M&A, or it can be investment in internal R&D, and we'll be supportive of that. At other times, if there's cuts and it just looks like our investment case is impaired, then we would have a tougher conversation.
You've just mentioned unforeseen circumstances there, like COVID affecting some companies. Running a bottom-up portfolio in the kind of these times of uncertainty with inflation, ESG coming into the fold. Obviously, there's been COVID recently, and there's obviously a lot of geopolitical events happening at the moment. How do you kind of continue managing bottoming up and ignoring that kind of noise at Baillie Gifford?
Yeah, so we don't spend any time trying to guess what macro outcomes are going to look like. We wouldn't be able to guess where inflation is going if you'd have told me back in the depths of COVID when we had negative prices on oil, I wouldn't have guessed we were going to 130. So we don't waste any of our time there. Typically with those type of macro questions, we look at it from a risk perspective, look at our exposures, try and understand if we've got any points in the portfolio that we need to be on top of or thinking about. But because we are not looking day to day, like when you're owning stocks with the idea of owning them for 10 years, if we don't do any transactions for the next 6 months, like that's not a disastrous outcome from us. We're not looking to churn the portfolio. We feel very comfortable with the quality within the portfolio just now. But then I think we look at these opportunities like we did in COVID, and like what we'll do with the inflation situation that's going on, to see whether there's any companies that we've previously worked on. We have done the 9-question research. They're sitting on our focus list that we have, that we can get the investment case out, kind of refresh it slightly and see whether there is a new opportunity. So it's looking to try and upgrade the portfolio as we can, but it's all very kind of patient, and there's going to be no swings in sectors that we're going to dive into or dive out of, or regions that we're going to try and get to overweight or underweight. That just isn't how we think. It's all about finding those companies that on a 10-year view, the fundamentals we think are very, very attractive.
And obviously we're all kind of witnessing horrible scenes with Russia's invasion of Ukraine at the moment. How has that affected what you're doing in your portfolio? Has that had any short-term effects, and what about in the longer term as well?
Yeah, so naturally that started off with the risk exercise to look at what are our holdings that have exposure. So in terms of direct listings, we don't have anything in Russia, don't have anything in Ukraine. So then you go down to the next layer of, well, what exposure do we have? Do any of our companies have material assets like the BP had the assets there? We don't have any companies that have got material assets in Russia or Ukraine. There are companies that have revenue exposed. So when you look at the portfolio through a revenue lens, around it was 1.03% of our revenue comes from those two countries, which is below the benchmark, and is so well diversified that there's no one company that stands out. So that's how we look at it through a risk lens. We're not particularly exposed. And then what are the second order effects? So we've got energy prices going through the roof. Will that mean we look to invest in oil majors? No, we don't see them as long-term sustainable growth companies. What does the second order effect mean does that mean interest rates are no longer going to rise at the fast pace? Don't know, but what that would ordinarily be is, should we have more banks, less banks? That's just not how we think. Banks, oil companies, not a good fit for our strategy, because too much of the future fundamentals are out with the control of management teams. It's about interest rates, credit costs, oil prices. We prefer to stick where we have management teams who are in control of the destiny, managing a high quality asset with a large growth opportunity. That's where I think we can add value rather than these macros. So there's no direct work that we're doing to try and find a name to benefit from the situation. But we do think with things like higher energy price, we've got names in the portfolio like Schneider, whose business is all about energy management, help I guess companies, governments, individuals control energy costs. Companies like Atlas Copco, who make industrial compressors, where their main sales pitch is energy efficiency. So there are companies there that will stand to see it as an opportunity to help customers in a tough energy environment.
And now, before I ask you some questions on inflation, we've got our second poll of the day for the audience. So hopefully we can get that up on screen pretty quickly. There we go. So second poll of the day. Please click a button and submit. So how do you respond to inflation risks facing your clients? There is the option of moving assets out of bonds into equities, buying all companies, buying more value funds, or no action. Or I presume you can hit no action if you'd pick a different option instead that's not on there. I'll just give you all a couple of seconds to answer that one and we'll get the results up. Lovely, here we go. Nobody fancies buying all companies. Almost half say no action, or I presume a different action instead of those. Ross, what do you think of the poll there?
Well, I'm pleased to see that no one's trying to pick up the oil companies. Yeah, I often feel glad that I'm just in my little box of equities and growth equities. I don't have to make these tough decisions for clients. What I've done with my personal portfolio, just kept with the growth equities. This is something like I plan on investing for a very, very long time. So I'm not trying to second guess next movements. So I guess it's pleasing to see nearly half the people sticking with no action.
What about your portfolio and your day job? How is that impacted by rising inflation? And in particular, if inflation is high for the next half decade or so, and it's a real, we go through a proper cycle of higher inflation.
Yeah, so as the topic was building through last year, we did some bottom-up analysis, both with our risk team doing quantitative analysis, looking at the portfolio through a lens of various metrics such as capex to sales, working capital ratios, profit margins, those kind of things, to try and see what the portfolio looked like compared to the market. And given our philosophy in buying growth businesses that tend to be capital light, high value add for customers, so high gross margins, we were not surprised to see that our exposure on a quantitative analysis looks lower than the market. So felt very comfortable that the portfolio is in the right position. We then onto that added some qualitative analysis. We, as a fund management team, went around the roughly 60 stocks and asked ourselves lots of questions, the same questions for each stock. Things such as, is this a small ticket purchase for a client or a large ticket purchase for a client? Are there lots of substitutes? Are there very few substitutes? To try and build a picture as to whether or not they would have pricing power that we thought. And we found actually about a quarter of the portfolio we think benefits from inflation. Companies like our industrial distributors in the US, who can put prices up instantly, but then have inventory that is at the older cost. We've got a car auction model, car auction business in Japan, which charges a percentage fee. So that fee goes up as inflation goes up, but it's on a fixed asset cost base. So that 25% felt fine. The bulk of the portfolio looked neither winner nor loser. And then we had about 10% of the names where we had questions, which we then just went and did follow-up work to try and see how material is this risk. Do we back the management team to take actions? And of those names in there were companies like AVI, a South African consumer goods company. There was UPS, the airline, Sonic Healthcare, a diagnostics company. And what's been really pleasing to see is UPS, the pricing has gone through incredibly to the point that their dividend went up 50% in the last quarter about. Sonic Healthcare have been aided by providing a lot of COVID tests. So they've actually come out as strong. And we're just at the moment seeing all the annual results coming through, and we're seeing the pricing power we thought we'd have is actually starting to shine. You see that with Procter & Gamble putting up prices, Microsoft Office going up 10%, analog devices pricing ahead. So every one of our companies, or the vast majority of our companies, we feel very comfortable. There's probably a couple that we will do further work on, but feel really relaxed on that topic of inflation exposure.
So in the last 6 months, you haven't had any turnover because of inflation or inflation fears going forward for any of your companies?
No, there's not been any action based on a future view of inflation. Like we have changed names in the portfolio, but not because of the inflation topic, because of a view on the fundamentals.
Okay, so I'm going to ping across the last poll of this session for everybody, and this one's on ESG. So hopefully we can get that up now. There we go. Poll 3. What is your current attitude towards ESG? You can tell us if you're worried about fund managers greenwashing, or if you feel it's critical to incorporate it in research analysis, or if you just think it's a fad. Be honest with your answers, and we'll see what you all think. We've probably had about enough time now for everyone to click a button and answer. Let's see what results we get. So 15% think it's a fad. It's probably lower than I thought some of our skeptical audience might suggest. 60% feel it's critical to incorporate it in research analysis, and a quarter worried about fund managers greenwashing. And I imagine some in the 60% also feel that way as well. So Ross, when you're selecting your stocks, how do you make sure you're going through the right, do you have checklists that you go through on the ESG front and sustainability front to make sure you're picking the right companies and they're not greenwashing, and subsequently you're not getting sucked into that environment?
Yeah, so we have a dedicated ESG analyst on the team, Ben Hart, who before we will put £1 into a new idea, we will complete our proprietary research template, which sits alongside the 9-question template, and answers the questions that we think are most important to get a view of the sustainability issues for a company. So it first focuses on the impact of that organization, both the impact of their products, but also the impact of their operations. You then, with that impact, we look at the ambition of the company to either capitalize on opportunities that impact brings, or sort out any issues or mitigate issues that come from that impact. And then lastly, trust. How much do we trust this management team, this leadership team, this culture to really deliver on that ambition? So Ben will do his own research, forward-looking, thinking about the future, not relying on kind of like historic scores to make a judgment on whether this is a holding that we should have should have any sustainability concerns. And that bit of research actually highlights what are the key engagement topics for us on the back of it if we were to own the company. Sitting alongside that, the second question in our research template that the investment managers are filling out is, how sustainable is this business model? So I guess when you're owning something for 10 years, you can't just outsource the thinking on sustainability. We need to own that ourselves, because any sustainability issue that were to arise is going to likely arise during our holding period. And so we need to think about whether they will impact the competitive position of that organization. So it's fully integrated at the decision outset, and then we have a program of ongoing engagement with our companies, focused on where we think we can make an impact. So sometimes it's perhaps on less obvious topics. It's not necessarily on the kind of the topic of the day, and it's not just about, can you give us more reporting? Can you tell us this, tell us that? It's actually making sure the companies are thinking about their impact on society at large.
And how do you kind of really figure out their culture on that front and get into the bones of it, rather than just looking at the spreadsheets and all that kind of stuff? How do you kind of really figure out what their intentions are?
Yeah, so a lot of it comes from conversations. I find it very difficult when you're simply reading to make a judgment on culture, particularly around sustainability topics, where sometimes I wonder if there's an inverse relationship between length of sustainability reports and kind of authenticity of content. So I think you really have to go and have the conversations. And that's what we spend so much of our time doing, speaking with former employees. So when I'm in the US this week, next week, and the week after, I'm sitting down with former employees from 4 of our companies, trying to get a feel for, tell me, what do you think this organization's like? What shaped the culture? Is this somewhere that you'd recommend for your daughter or son to work? Try and get a feel. I think it's having lots of those conversations. And that's where Hattie can add a lot of value, because she can go away and speak to 15 or 20 of these people and collate it together. And you pick out the themes quite quickly. So I think the judgment on culture is one of the hardest ones to get. It's the one that takes the most time, but it's one that we have to get right. And there's not just one culture or one trait of cultures that are great. Like, you can have different types of cultures that work if they fit that business model and the customers that they're looking to serve. So it's a hard one to get right, but it's one that we spend a lot of time
on. Just a note to everyone that I've seen all the questions coming in. We've had a fair few come in, and I'll make sure they all get answered in the next 15-20 minutes or so. But just looking forward, Ross, and with sustainability and ESG in mind, where do you currently see opportunities to invest in new companies in Baillie Gifford? Are you looking at renewables and that type of thing? I think someone's asked that as well. So do you see clean energy and renewables as a kind of a strong point for growth and income?
Yes, so I know there's a number of people currently working on projects on things like green hydrogen, trying to look and see whether there's key enablers that we can invest in there. I think quite often with these startup brand new technology companies looking to solve the issues, quite often these are immature businesses, not yet cash generating, and so will not be paying dividends. So there's a large part of those that perhaps aren't accessible to us. But there are a number of large companies, more mature businesses, that have got a large role to play in that. So take Midea, for example, the first Chinese A share that we bought in the portfolio. They've got a large HVAC business, and so they see themselves as having a huge role in driving energy efficiency within the HVAC industry. They're in my opinion, down to kind of 1 or 2 players that are really innovating in that market, and so they can capitalize on their innovation as standards become tougher and tougher for minimum environmental regulation. But I think for us, there are so many companies in the portfolio that can be solution providers. Schneider, I mentioned earlier, focused on energy management, and less obvious companies. Rather than I've not yet found the dividend paying team that we believe is going to develop the carbon capture technology. There are many people in Baillie Gifford who are doing a lot of work just now trying to understand where the future might present these opportunities. Obviously, large areas of Baillie Gifford got access to private investments as well, where I guess a lot of this is going. But I think we see within our businesses, take another company, software company like SAP, who have full visibilities of supply chains. These guys can be real enablers, and this can be incremental revenue generation for them if they become a solution provider to their customers. So we see enough opportunities to participate in this long-lasting thematic that is emerging.
We've had a question in. We spoke about COVID earlier, but someone asked what happened to your specific portfolio during 2020 compared with previous years. I'm assuming, wanting to know how it performed in a negative year generally.
Yeah, so our portfolio outperformed the market in kind of unit price or share price terms by around 3%. I think the number ended being, I think more interestingly, in the proof point of our focus on sustainable income was at a time when the global income fell 12 to 15%, and like I said, France and the UK fell kind of 40 to 50, our income will only be down 3%, felt like a real kind of proof point in what was an incredibly extreme environment. When you think about normally when you plan for recessions, you think about things slowing down. There was a number of businesses where revenue just went to zero overnight as they couldn't get their goods and services to customers. So I think COVID, the COVID period was a real validation of our focus on dividend dependability.
And then a kind of similar question, but someone's asked, Baillie Gifford's having had a tough couple of years, I think, because growth stocks have generally suffered a bit recently. And they ask, is there light at the end of the tunnel? And I can guess your answer, but I'd like to hear it from you.
Is it like, yeah, no, absolutely. We can't make a call on when the value versus growth rotation will stop. That comes down to judgments on inflation and interest rate. I think where we can add most value for our clients is just continuing to find those great businesses of the future and focus on the fundamentals. So I think it's really reassuring to see how everyone is just getting on with their investment analysis, sticking to their philosophies. This is what we believe works for the long term. Because there's a short-term value rally, our beliefs don't change. We don't try and go and chase these type of events. We stick to what we're doing. And it is, like I said earlier, of the kind of partnership structure, there's no sense of panic around the organization. We know that if we keep delivering, then or keep trying to uncover these next generation businesses, will be a good step. And one thing that I thought was really interesting was when the new senior partner took over at the end of 2020, a period when the Baillie Gifford performance was incredible, off the charts performance across many strategies. His kind of statement of what he was going to do was double down on our research platform, focus on how can we get more insights from academics, industry experts, and then also double down on our learning. What can we do to become better investors? Who can we look at? So a period where I'd imagine the natural tendency would be to think you've pretty much cracked it. It was very different. It was a case of what's worked in the past. We need to build on that, not just rely on that. And I found that kind of humble approach really reassuring for me as someone who's relatively new into the business at that point.
And we spoke about inflation earlier and how that can, how you analysed your stocks against inflation, how they might perform in the future, and looking at that into the medium to long term. Are there any other kind of more macroeconomic phenomenon that you're assessing in that kind of similar way and putting as much emphasis on as inflation?
So like I said, like the work on inflation was largely through a risk lens. So we have quarterly risk reviews where we look at the portfolio, and then we have proactive bits of risk work that we commission in advance of that. So one of the things we're wanting to understand better is the future of China as a dividend paying market. So of those over 5,000 dividend paying companies, actually 1,200 of them already today are in China, and obviously many of those won't be appropriate for our strategy. But we're doing, if you want to call it, as close to kind of thematic work. We're trying to understand what the future of the Chinese dividend paying market might be, and like the biggest theme that runs through our industry and through some of the thinking just now is we've now got this additional massive thematic driver of ESG. Where does that present itself as opportunities? Which are the businesses that get that, understand the importance of that, and will capitalize on what that throws? And where are the companies that are still ignorant of it, thinking of it as a fad, and ones we need to be very mindful of avoiding? We don't typically think in these big themes, but those are some of the types of conversations that we have been having.
And then we've had a question in which says, would you classify Baillie Gifford as having a general buy everything strategy with the idea that 2 out of 100 players come through and pay for the losses of the other 98?
No. So I think we are highly selective in what we buy. Like, we are absolutely open and aware of the idea that we will make investment mistakes, and so you need a portfolio, but we prefer to have a more concentrated portfolio. I would say we own 60 companies out of 5,300 that theoretically we could own. That's pretty selective, and we do appreciate, we've talked publicly about how it's very few companies that do make up the majority of market returns, and you need to get those extreme outliers right, and you're not going to get every single one of them, so you need to buy those that you think have got the highest probability. But that doesn't mean buying everything. That's buying a portfolio of, whatever you want to call it, 50, 60 stocks in the kind of, with the aim of finding those extreme outliers.
And someone else has asked whether your ESG checklist is integrated with fund selection. Oh, I think someone's just shared their screen there. If you could unshare your screen, that would be great. I don't think it's one of us. Wayne, if you could stop sharing your screen, I think you've hit the wrong button. But anyway, thank you. Ross, sorry, I was asking you whether someone's asked whether your ESG checklist is integrated with your fund selection. I think you kind of addressed that earlier, so I'll kind of develop the question on, I guess, and say, how long has ESG been integrated to the extent it is now in your fund selection, and how is that evolving over time, and how is that going to change going forward?
Yeah, so obviously, with the long-term focus, sustainability has always been the key focus when we're talking about the future of the business. What we've probably got better at in the last couple of years is articulating to our clients what it is that we do. Like our 9-question framework, the IA Impact Ambition Trust framework, we continue to iterate and make that better, see what works, take the learnings and upgrade it. But the core questions that we have to answer have been the same questions that we have been trying to answer. There's more emphasis on this externally, and having Ben now as a full-time analyst who sits with the team, not a separate team, he's very much one of us, is really, really important. What we have developed over the last 3 years, and just got a 3-year track record, is a responsible version of global income growth for those clients who have perhaps a slightly higher bar on sustainability topics, to the point that they may want to for us to be even more selective and have a higher threshold for what we think counts as a sustainable investment. But that's very much like on a product and a client front. On the kind of the investment research, it's for as long as I've been here, before we would buy any company, we would wait to make sure we get the thumbs up on the Impact Ambition Trust research that this was not a company that we had any issues with. And I've seen us wait for follow-ups on Impact Ambition Trust research before we'll pull the trigger, to make sure we are fully satisfied, because that is really important for us to get right. Because if we get that wrong, then an investment case can unravel very, very quickly.
And someone's asked, given the Russia-Ukraine conflict and Europe's decision to reduce dependency on gas and oil from Russia, are you looking at renewable energy as a sector in any specific areas? I suppose I kind of asked this earlier, but what specifically are you looking in that area? And has the conflict kind of changed your minds or accelerated any thinking in that area?
So not really. When I think about exposure to renewable in the portfolio, so we do have a company called Greencoat Wind who own wind farms both onshore and offshore all around the UK. So that would be one position we have in the fund that is very much exposed to energy prices. Energy prices is going up, as we saw that when they raised the dividend 7.5% just last month. They're thinking through the pipeline of ideas that we are focused on just now. There are companies like, there's a European capital goods company where we think they're going to take a lot of market share in their service business, and part of the reason for that is because the energy efficiency savings they can bring to their customers. But it's not a renewable company per se. So other than kind of work that's going on to try and understand hydrogen and whether any of the traditional kind of air companies like an Air Liquide, etc., can see us as a great growth opportunity. We haven't yet found that dividend paying renewable company to add alongside Greencoat, which we think serves a very good part of that purpose.
Sorry, I just got muted. Someone's got their microphone off. There we go. Just another technical glitch. That's the joy of running these online sessions. So, Ross, obviously we've spoken a bit about what's going on at the moment, but how do these kind of turbulent times affect what you're doing? I suppose day to day. You're a long-term investor, but how do the kind of conflicts going on at the moment impact your decisions day to day? Is it going to create any portfolio turnover, do you think, as well as, we analysed inflation earlier, but do you think anything will come of it?
So I think the short answer is they don't really impact what we do day to day. So like I say, I don't have Bloomberg open on a day-to-day basis looking at where share prices are going. That's not something that I can add any value to. Our approach in times like this is very much stick to what we know what to do well. So through the COVID crash, when there was dividends getting cut in the market left, right, and centre, there could have been a natural tendency, given our desire to provide a sustainable income to our clients, to go hunting some of these higher starting yields to kind of patch a gap. That just didn't come into our thinking. That was just never a kind of belief. We think we are, or we're convinced we've got the right way to do income investing for clients who want real growth in their purchasing power over a very long-term horizon. And so we don't try and plug those short-term gaps by getting into companies that we don't think are a great long-term fit. So we really don't make big changes. If there are opportunities, like I said earlier, to upgrade the portfolio, and whether that be a company that we've previously done the work on, and we can make the investment case stand up, and something we have higher conviction in than other names. But like I said, when I look through the names that are the bottom of our research funnel, closest to getting into portfolios now, none of them are there because of what's going on in Russia and Ukraine. None of them are there because of inflation. None of them are there because we're trying to get more exposure to a sector or a region. They're there because on their individual merits, we think great management teams, great asset, great opportunity on the long term, and it's a good fit.
Someone's asked if you employ any technical analysis when looking to put on a position. I suppose we talked about that on the ESG front a lot, but perhaps not technically, if you want to address that.
Yeah, so the long and short is no.
Beautiful. And then someone else asked, is the strategy purely growth stocks, or does the value provide opportunities? And I know Baillie Gifford's a growth company, generally, but in the income space specifically, do you ever see value stocks offering, that kind of income opportunity?
So plenty of value stocks offering an income opportunity, just not an income opportunity that's suitable for what we are trying to achieve for our clients. So there is no desire to move that balance between growth and income. We wouldn't trade off one or the other. The start of our 9-question template is all focused on the growth of the business before we get into income and dependability. And so that won't be changing. We will not get an investment idea into the portfolio if it is not got a robust growth case. That's simply just that would be too much of a, I guess, philosophy shift for us. No intentions at all to chase what's going on in the oil price. It's a small part of the market. It's probably having some short-term headwinds for our performance, but to me, investing in oil and gas is not something that I think I'm in a position to say this is a great 10-year investment for us. It feels a bit like kind of picking pennies up in front of the steamroller at the moment. So we'll just stick to what we know, and we believe if we get the fundamentals right, everything else will take care of itself.
Brilliant. I think that's all we've got time for today. Thank you everybody for sending your questions in. If they haven't got answered, we'll make sure Baillie Gifford do answer them for you after the session. Thank you, of course, Ross, for joining me today.
Thank you very much.
And of course, for letting me and the folks at home grill you with all our questions. On that note, as I said, if your questions didn't get answered, Ross and Baillie Gifford will do their best to do so after the event. Now, our learning objectives are on screen, and hopefully we succeeded and Ross succeeded in addressing all of those. And before we close up, I should assure you that your CPD will be delivered tomorrow. On that note, there are some people who haven't filled in their names properly on the Zoom call. There's a Mark, Andy, James, 2 Mikes, and another user unaccounted for. And if we don't learn your full names shortly, we won't be able to send you your CPD. Now, before we sign off, let me just remind you of some dates for your diary over the next 2 months. On the 30th of March, we'll be running the next episode in our series of Professional Advisor Working Lunches, this time with Schroders, who will be discussing the key business issues coming out of their Q1 Advisor Survey. Then in April, we have our 2 biggest events of the year. On the evening of the 26th of April, we'll be running our annual Professional Advisor Awards, where we'll celebrate the very best in the business at a glittering event at the brewery in London. Then the following day, on the 27th of April, we'll be back at the brewery for the UK's largest annual management conference for advisors, PA 360. This year, as every year, we'll have a packed and varied programme with more than 40 speakers covering every aspect of running an advisor business. We'll start the day with a power panel where the CEOs of Fintel, Tenet, True Potential and Sesame Bank Hall Group will give us their view from the top in what is set to be a challenging year for advisors and advisor businesses. And our keynote speaker in this Commonwealth Games year is none other than the double Olympic gold medalist, Lord Sebastian Coe, who also brought the Olympics to London in 2012 and was a member for Parliament from 1992 to 97. Lord Coe will be offering some insight on how to incorporate the disciplines of elite sport into effectively running a business. All in all, 7 hours of CPD in London on the 27th of April, which will be a fantastic event for you advisors. And if you're in the North and can't make it down, don't worry, we'll be bringing your annual PA 360 North conference to you in October. So that's it for today's session. All that remains is for me to thank you once again, and Ross once more, for your time today, and of course Ross for answering all our questions. But our biggest thanks goes to you, our readers, for your company and time this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again soon. Goodbye.